What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is December 13th of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to talk about the one critical factor that everyone seems to be ignoring when it comes to both Bitcoin and crypto markets, and it is going to be the single and biggest determining factor as to whether or not we can really continue this rally going forward. We've got a lot to unpack here in today's video, and as you all can probably tell, I'm a bit sick at the moment, so if you can be patient and tolerate me, I appreciate it. And if you guys do end up liking the video, not only consider dropping a like, but if you want to help a brother out here, let me know some different remedies that you take when you get sick in the comments down below, especially those recipes or tea recipes that your grandma would give you. We all know that grandma knows best. All right, let's go ahead and kick things off here. Now, I want to start by talking a little bit about what we're looking for within price action, guys. Ultimately, above all, I'm a technical analysis person. I look for what price is signaling to me, and I don't try to overcomplicate things. I don't like to use millions of indicators. I like to use the core ones that have proven track records when it comes to giving us some degree of predictability on price. I want signals that are letting me know that price is confident. And right now, we are still seeing confidence here in the sense that price is holding on that 21-day EMA ever since we came back here through the cross on October, getting above the 200-day and 200-week on the breakout on October 16th. And just since then, we've again been continuing to trend on this 21-day EMA, even with the 6% pullback we had the other day and the total 10% pullback from top to bottom between here on December 8th and here on December 11th. However, while we are watching for this price confidence here, and while that is going to be one of our biggest determining factors here for Bitcoin, the big thing I would let you guys know about before we dive into the biggest topic of all is that it's common that you're going to see in a crypto bull market, for example, and this is again as someone myself who has been of the opinion that we are likely not in a bull market. I've been in that position for some time. That all being realized, right? Again, while we can see that the trending period here is generally going to be above the 21-day, you can get some periods where you break below the 21-day. Needless to say, though, as we go throughout history, right, if you don't see price recovering above that 21-day soon after and avoiding some of those longer term moving averages like the 200-day, that could be a sign for trouble. We can analyze this in 2017 and 2016. This was the first bull market we traded. Price rarely spent time below that 21-day EMA as we went throughout history. It spent the majority of time above it. That is indicative of a confident trend. And we even saw in the last bull market when it was from the absolute lows to the 14K rally point during the summer of 2019, or from the period of 2020 in October 2020 where we really had the big breakout here up to 66K or 65K at that time, we saw that price barely stayed below the 21-day. There's a big reason why this moving average is imperative here, guys. It's not just a great point to potentially look for buy the dip opportunities, but also when you get these breakthroughs below that level, if it starts to act as resistance or price is not able to get back above it, that can be your warning sign. Now, this is all just price analysis talk, though. What's the really big topic we're going to be talking about today? Well, the big topic we're going to be talking about outside of analyzing, what's going on in the altcoin market. Again, here we're watching, again, what it's going to do here to the 21-day. Again, same exact principle. We're watching what happens with Bitcoin dominance here. And we're also going to be watching, again, for increased confidence in the EXBS index against Bitcoin, which we still just haven't been seeing yet. It's neutral here with the last 2 months. And outside of that, it's really been on a longer-term downtrend, if we're being honest, mainly due to Ethereum. But I want to go ahead and talk about the topic of global liquidity. Now, I understand here, guys, we've covered this topic a few times on the channel in the past, but I want to talk about just how far detached we've gotten when it comes to either crypto markets or equities when it comes to the separation and the trend in price versus liquidity. And I'll make it very clear here, as many of you probably claim yourselves if you're on the optimistic end, yes, it is true that liquidity increasing or decreasing on a daily, weekly basis does not exactly compute to what price is going to do. That's fair to say. There can be periods of time where liquidity is generally declining and asset prices may kind of hold up for a while. But generally speaking, we tend to find that there is eventually a correction, a return back to the mean between these two different values. And it makes sense because at the end of the day, as we've seen through massive expansions of liquidity, this is generally where asset prices do very well. We saw this from 2014 to 2018, where global liquidity went from around 15 trillion to 20 trillion. We also saw asset prices stall across the major stock indices, as well as the crypto bear market get into full swing in 2018 as global liquidity stalled. And we also saw the resurgence in 2020 and 2021, with Bitcoin going from around a few $1,000s up to 65K. And altcoins going out the wazoo, in total making up trillions of dollars of market value and evaporating a lot of that as liquidity has started to correct. However, the element that I feel many people are missing on now is that they've stopped watching global liquidity. And many people are going off of the narrative that was shared in the near term, which is that liquidity is re-expanding. We found our bottom in global liquidity. That's what everyone's been cheering since back in September and October when we set in our relative low here, a new low, by the way, in global liquidity. We've been able to see global liquidity come from around 24 trillion up here towards 25 trillion. And if you think about it, I know a lot of people would say that, oh my God, $1 trillion, Nick, that's a ton of money. Well, in the grand scheme of things, that's less than a pretty much 5% expansion from that point, right? So the key point I want to make here is that unless we're seeing a significant long-term trend and more confidence probably back than the previous expansion back in October to January of 2023, right? October 2022 to January 23, there was bigger expansion. There was around 2 trillion. And we only see a $1 trillion expansion from a lower point of liquidity. Just how far gone are we when it comes to the valuations we're seeing in markets? Well, I want to go ahead and utilize equity markets here to demonstrate this. First off, we need to talk about the excessive valuation premium that we're seeing here. If we just take a look at prices, right, the Vanguard Total Stock Market ETF is at its highest point since back here between the period of Q1, between January to March of 2022. So we saw a huge move in November. November was a great month. It took back these 3 months of losses here, which is definitely a sign I like to see when it comes to market price, that the recoveries are outpacing the periods of time it takes for price to correct. I love seeing this optimism in price as a trader. However, it is important to not negate the fact that it is going to be incredibly difficult for equity prices to significantly break above this prior resistance range. There was already multiple months of resistance back here during an optimistic period of time where there was easy money and equity prices were not able to climb above that range. We can even see here on the Lux Algo indicator that we utilize with the trailing band here, this is going to serve as steady and heavy resistance for price between the 232 range to 250. I think it's imperative to watch how price reacts at this range, because we've seen the last time we came up here, this is where resistance started to kick in, and on the earlier part of the band, not the higher, more top level resistance. Now, outside of this as well, we can also see as well that there's a huge concentration when it comes to a few key stocks. We can see that Apple and Microsoft have steadily outpaced the broader S&P 500 as well as the NASDAQ, and they have consumed a large portion of the market. But as something we've indicated within the Dash Report, our newsletter here on this channel for the past year, is that we've seen a clear trend shift as of 2020. Where these names are no longer accelerating in their market share, market dominance as much as they were from 2016 to 2020, and much slower from the overall trend from 2006 here to 2020. These prior market leaders that have been swallowing up large swaths of market dominance, albeit they are still setting in slightly higher levels, are not the same market leaders and the same confident players they used to be. And this is, I think, the first indicative sign here that unless we have new market leaders out there, unless we have a whole new swarm of new FANG stocks, new replacements for Microsoft and Apple here, the market is hungry for a better pullback here, a better discount opportunity, especially if we come down here like we did back in January 2023 and the concentration of these stocks and potentially break through the monthly support band here from Lux Algo. If you guys haven't already, I highly recommend you guys check out Lux Algo down below in the description. They have their holiday sale going on right now. It's one of the few indicator suites that I really like to use personally here on the channel, and we use it in a bit of a creative way. We modify some of the visual settings and we focus on using those those trailing bands in order to spot long-term support and resistance utilizing the weekly and monthly time frames. You can, as I showed here, use it in equity markets or crypto. In crypto markets, I recommend looking more at the weekly and monthly time frame, but in equities, you can step more comfortably in the monthly time frame considering the time range that you have to work with. And you guys can get 35% off utilizing our link down below in the description. But ultimately here, guys, I want to go ahead and talk a little bit about what's going on here with the valuation premium. This is the big point I really want to hit on home on here. And I think this is why, as we were taking a look just a moment ago at VTI, why there's that resistance band at that critical range and why price has really struggled to make new highs for the last few years, even with the recovery in price. We need to take a look at where assets are priced versus global liquidity. And once you start to see this here, it becomes abundantly clear that assets are trading at an absorbent premium versus the last decade. You might think for a moment that asset prices were even crazier in 2021. And if you're just looking at the actual value of stocks, you'd be technically right. They were slightly higher than where they are now, right? And this is true across all the indexes. The NASDAQ was still around 1,500 points higher. The S&P 500, albeit not too far away, is still only about about an 80-point difference here. If I'm not doing my math wrong, about 180-point difference here. So again, not a crazy differential here from where we are now, but still definitely a higher range. However, what we're doing here is taking our stock market indices, VTI, the Vanguard Total Stock Market ETF, the S&P 500, and the NASDAQ, and we're dividing these separate indices by global liquidity. And it paints a really interesting picture here, guys. It showcases that right now we are trading at the highest equity value premium since back in 2008. Now, what's very interesting here is that for more than the last decade, the last 13 years, this red line on the chart here has been a clear sign of tops. It called the top in February of 2020 before the COVID crash. It called the short-term recessionary top here in 2015. There was the scare around the China recession and the Shanghai composite bubble that was bursting at that time. I remember trading during that window of time, one of my first real major market corrections. And outside of that as well, in 2011, here between January 2011, more importantly, a little bit earlier on here, and the flash crash in 2010, and also as well here towards November 2011. Well, now we are back on the upper part of that band again, right where we were back in July at the highest equity premium against global liquidity in our history since back in 2008. Now, I'll be honest and the first to say here that is there a chance it could break higher here? Are we still far and few away from the equity premium that was paid for in 2007 versus global liquidity? Yes, that's true. We are, and there's a chance that that could start to break higher here. But I would put it this way, out of all the reasons that could really get us out of here, what would be the reason that actually leads us out here today versus back here? The only thing I can think about here is AI. Is specifically not just generative AI, but in this case, artificial general intelligence, right? A real artificial general intelligence that is as capable of reasoning and creativity as a human being, right? And that's a very important thing to understand here, guys. If you've actually used generative AI, it can be a powerful tool, and it definitely could boost productivity in some elements, but it's not artificial general intelligence. And there's been no clear development of that just yet. And while maybe the market might price it ahead of time, it's not going to continue paying this kind of premium going into a recession off of some hope that there's going to be artificial general intelligence. And this is not just the VTI ETF, it's also here in the S&P 500. You see a similar pattern here with the risk premium that people are paying on a lot of these names. You can see the NASDAQ has gone well above its highs in 2007. And I think this further indicates here that, again, we really need to not get separated here from the reality, guys, which is that while there's a lot of euphoria, as there tends to be when there's euphoria, people are paying ridiculous premiums for these names. Apple and Microsoft, while they still hold such a huge market concentration, are not seeing massive earnings growth. And it's difficult. You really can't blame them for it. There's really not many ways that Apple and Microsoft can double their earnings, right? Sometimes when you get towards a company that's making $100 billion a year, which is what Apple's making, for example, a titan of a company, and Microsoft's not too far behind, it's hard to double that amount of earnings in a given year. There's only so many people you can provide software, hardware, computer devices, mobile phones, whatever you can think of that these companies might sell. They can try to build new devices, they can try to build new avenues. There's only so much they can sell. And while they are highly competitive companies and they're very valuable in their own right, I think these valuation premiums cannot be ignored. If they don't have the matching growth, they are going to get shot down like they have multiple times, right? And again, I'm here to say that it could potentially break out to the upside, but if you want my opinion, if you want me to kind of stick my foot in the sand and make a clear statement and try to bet on one outcome or the other, I'm going to probably lean into history here that showcases that since 2009, this has been a resistance point for the NASDAQ. And sure, maybe it deviates a little bit above there, right? Maybe we miss a 3% move in the NASDAQ or a 5% move. But for me, I want to be buying on discount opportunities. I want to go heavy into some significant discount opportunities, especially in an environment where global liquidity is making lower highs and lower lows until we break out of this wedge, which could be a descending wedge here, could break out higher. The Fed and other central banks may decide to monetize their way out of this fiscal crisis for the United States government and so many other governments across the world, such as China and also in Europe as well. Or if it's the opposite direction where they really, tighten things down, whatever. I'm going to wait for a clear trend here. I don't feel very comfortable buying into a $1 trillion increase in global liquidity when back here we went from 19 trillion to 29 trillion. The magnitude of this liquidity expansion is the kind of stuff that creates euphoric rallies. These are the type of liquidity bumps that create relief rallies. And I think that is one of the biggest things we need to keep on our radar here when it comes to the premium that people are paying here for Bitcoin. We can do the same here for Bitcoin. Basically, if you guys wanted to see it, you can basically take the Global Liquidity Index, which we give out to the Dash Report members. I feature it here on the channel sometimes, so you guys can at least see the metric from time to time. But generally speaking, it puts Bitcoin probably up here at the same range it was at in December to April 2022, roughly around the 48K price range. My point here being is that we're back towards the euphoric highs, practically speaking, of where we were back in 2021, from the earlier part to the later part of the year. And I have to ask, whether it's Bitcoin or the broader crypto space, do we really deserve that value? Do we have the liquidity momentum helping us? Is it just because there's a Bitcoin ETF now that this is just going to go to new all-time highs? I don't think so, guys. I still stick to my guns here that this is not the probable scenario. Doesn't mean that there aren't some short-term opportunities. I'm not trying to be a perma bear. It's great to see that price has been trending here, but if you're asking me the question of whether or not we're going to break to new highs or really just kick off to 100K to 200K, that's a very big bet to make from here. So I would only say to exercise caution. Watch how price reacts with that 21-day EMA. Make sure price isn't spending too much time or let alone using the 21-day as resistance. And outside of that, keep track of global liquidity, because if this starts to decline yet again and we break through this line of support versus breaking through the upside, that will tell you all you need to know about where the Fed, where the ECB, where the Bank of Japan, where the People's Bank of China, where the Bank of England, and all global central banks, and the Treasury General Account, which so many bulls like to cite, all of these things that can create stimulatory effects on financial assets, what they're really going to do net overall. So anyways, I rambled on a good amount here, guys. I hope you appreciated the video we put out today. If you do, consider dropping a like, and I hope you guys also could tolerate me. Again, I don't like to be sick and doing content, but at the end of the day here, I want to make sure I get these updates out to you guys. And if you guys are interested as well, and checking out any of the tools and things we discussed here in today's video. Again, you can always check out LuxAlgo, one of the few indicator suites I'd really candidly recommend here on the channel. I like using LuxAlgo here for those longer term trend shifts. And again, you can get the 35% discount at the link down below in the description. And outside of that as well, you guys can always check out the Dash report down below in the description. We've got, coming up here on about 2 more weeks here for the month of December. Next year, early in the year, we're planning to raise the price of our newsletter. We haven't risen it since back in 2018 for 5 years, so it's well overdue for a price increase. If you guys want to lock in the annual rate at $240 a year, less than a cup of coffee a day, where you guys get access towards a 20-page plus news report, our trade alerts when we finally start making some of those moves in the market, and outside of that as well, getting access towards our mid-month webinars. We have actually got one coming up here this week where you guys can ask me questions. We'll dive into the charts, all that kind of stuff, and you want to lock in and grandfather that rate, you guys can do so here before the close of 2023. It's a great way to support the channel, irrespective of whether or not you're interested in the content, and you get a lot of additional bonus content on top, as well as some exclusive market updates and the Dash Report discussion group where you can chat with other Dash Report members. But I've rambled on a good amount here, guys. Hope you guys are interested. If you want to check that out, it's down below in the link in the description. But until the next video, I'll see you guys on the next video on Friday. Take care, stay safe, and I'll see you all in the next one.